InFi, episode 33.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm going to be speaking with Bobby Samuelson, who is the editor of the Life Product Review. And specifically, we're going to, once we get going in this conversation, be focusing on his December 2023 article in the Life Product Review. It's number 385 in that series, called Proof, Pudding. And so basically what he's doing is he's making this free for one thing, so it's a subscription publication, but this one's free. And it's good that it is because it came on my radar. And it just goes through it. It's the best analysis I've seen of an historical whole life policy and how did it actually perform relative to its original illustration. And Bobby just, he does a great job going through explaining the mechanics of it. And he's even got notes from the agent who originally did the illustration. And this was from 1988. All right, so it's amazing. I think it was one of Bobby's relatives or something that had this policy sitting in a drawer for decades and then let Bobby look at it. So that's the meat and potatoes of this episode. But more generally, what I really like about this is I think we give, and when I say we, I mean I set Bobby up to hit it out of the park. He did the explanation of what exactly is the dividend rate inside of a whole life policy. And so it's not the exact same thing as saying, oh, if I pay my premiums, what's the internal rate of return on my cash surrender value going to be? Like what most people have in mind when they say, what's the return if you invest in whole life as an asset? But the two are related. And so I think Bobby does a great job of explaining the relationship and how to think about it. So that's the main, like I say, portion of this episode. Let me just give you a little bit more background about who Bobby Samuelson is. So here I was reading from his bio. So he's an editor of the Life Product Review. He's a frequent keynote speaker at industry and corporate conferences, has authored and co-authored articles for publications such as Trusts and Estates, and has been quoted in the Wall Street Journal. Bobby is also the president of Life Innovators, an independent life and annuity product development company. Prior to reestablishing the Life Product Review in late 2017, Bobby was senior vice president and head of product development and pricing at Bright House Financial, formerly MetLife's U.S. retail division. He and his team developed, priced, filed, and supported all new and in-force life and annuity products sold by Bright House Financial, including fixed, index, and variable annuities and whole life, universal life, and term life insurance products. Before joining MetLife in 2013, Bobby was an author, speaker, and consultant to life insurance companies, independent distributors, producers, and high-end clients and their advisors. He also published the Life Product Review, a weekly newsletter providing qualitative and quantitative reviews of life insurance products and strategies. He started his career at National Financial Partners and is the third generation of his family to work in the life insurance industry. So here, folks, is my conversation with Bobby Samuelson. Bobby, welcome to the InFi podcast.
Thanks for having me.
Well, I'm glad we could finally make this happen. Somebody, I don't know, a while ago sent me, a few months ago, I guess, sent me your article from December 2023 on whole life policy analysis and said, this is the best thing I've ever seen. And I agree. But before we get into this, that's kind of the meat of what I want to go through in this episode. But before we get into that, maybe just see if we could let you explain your background and like what Life Product Review is and Life Innovators.
Sure. So I'm third generation in the life insurance business. So I come by this pretty honestly. My granddad was selling insurance from 1962 until about, 2012 or so.
Huh.
And then my dad started in the business in 1982. And my mom actually was an agent as well. So definitely come by it honestly. I've never been an insurance agent. So my background's always been on the product side. My first job was at a brokerage firm in Austin, Texas, NFP, which at the time was the largest independent distributor of life insurance in the country. And I literally remember first day on the job, sitting down, running a life insurance illustration, seeing the numbers, turning to the guy next to me and saying, where'd the numbers come from? And he says, oh, that's just like a bunch of actuarial stuff. And I thought, that answer's not good enough for me.
Mm-hmm.
I really want to understand how this works. And so I've kind of built my whole career chasing that question to some degree. So worked there for a couple of years, left in 2009 to go start my own little consulting firm at 24 years old, basically helping high-end producers close large transactions, doing all the numerical analysis and all the product analysis for them. And then along the way, Index 2L becomes this big thing. And I'd kind of been the in-house Index 2L guy at NFP. So I started giving speeches and presentations on that, 100 plus a year on kind of what was going on in the IUL market as it was a nascent and growing space. And then I realized one day, hey, I'm on the plane all the time. I flew like 200,000 miles, one year. And I thought I should do something productive while I'm on the plane. Why don't I start writing a newsletter? Mm-hmm. And so I started writing this newsletter called the Life Product Review and charged for it. And I thought no one's going to buy this. And actually a lot of people ended up buying it, which was great and very encouraging. And then I, later on met Life and moved to Charlotte. And I thought, I should go work which is where I live. I should go work for an insurance company, see how the sausage is actually made. So I spent 3.5 years at MetLife, ended up running all the product development and pricing for life insurance and annuities for MetLife US Retail, which then became Bright House. And then I left in 2017 and restarted my newsletter. And so the newsletter is just a weekly musing on what's going on in the life insurance space. And it's a technical newsletter. So it's all original research. Everything I write I'm pulling from illustrations. I'm pulling from regulatory filings. I'm pulling from Blue Book statutory analysis. I'm pulling in cases that I see people randomly send me. So it's very, very analytical, but also pretty applicable from a sales standpoint. Sort of like, how do you translate this to what's actually going on in the field? And then so I do that. I still give 50 to 60 speeches a year on what's going on in life insurance. And then I started a product development company, mostly on the annuity side of the world. We do some life stuff as well. And we basically serve as an outsourced chief product officer role for small to mid-sized insurance companies who don't have in-house product people and can't find them. So we have a bunch of clients. We've got about 6 employees now, a couple of actuaries, some marketing people, product development people. And that's what I do. But I'd say my first love is the newsletter. Mm-hmm. I love, covering topics every week. There's always plenty to write about. And we actually have an annuity publication as well. And it's sort of funny because the annuity publication, there's always new stuff going on in the annuity space. So I always have plenty to write about in terms of carriers making changes or pricing changes or whatever else. The life insurance world's a little bit more static. And so I'm constantly finding myself having to find things to write about in life insurance. And so the article you referenced is one where it's like, hey, that's a story as old as time, but sometimes it needs to be retold and told in a different way. And that's a lot of what I do with Life Product Review.
Okay, great. Yeah. The listening audience here, Bobby knows this, but let me just, for your background, for me, I was an academic economist. And then at some point I was in Nashville and somebody introduced me to what was called infinite banking. And I didn't even know what a whole life policy was at that point. I had a PhD in economics, but I thought of life insurance as a term. And then, so it took me a bit to undo the black box. And once I understood how to read the illustration, and then, it started making sense. And what was funny is one of the big things about what made me take the concept seriously was I first did my due diligence and I went and I read all the critiques of it I could find. Because you go Google, there's all kinds of people telling you that permanent life insurance is a terrible investment. And of course, the big bugaboo is buy term and invest the difference. And the guy there in the US is Dave Ramsey. And I went through his, some of his standard shtick. And it was such a non sequitur of a critique. You know what I mean? So I kept saying that doesn't prove that whole life is a good place to put your money. But clearly, I was looking at what was told to me to be like, yeah, this is a no-brainer. Only idiots would do that. And I was like, no, there's like 9 things wrong with his analysis. So anyway, so I'm bringing that up partly because I saw in your article. And by the way, folks, so it is a subscription newsletter, but Bobby made this December 2023, so it's numbered 385. Article free, and it's good that you did because that's how it allowed one of our agents to see it and send it to me and say, whoa, you should get this guy on the podcast. This is great stuff. So that's partly I went through that, Bob, just because I know in the beginning you explained. So one of the key things is here, and then I'll let you rip, is, Dave Ramsey be like, oh, you can just get life insurance coverage, death benefit coverage on so much cheaper terms if you buy a term policy. Why would you're flushing money down the toilet with these overpriced whole life policies? So can you take it from there?
Yeah. So that was kind of a funny, every article takes its own little path of how you want to tell a story. And so this was really kind of 2 articles in one that turned out to be one really nice cohesive story because like you, I too hear the Dave Ramsey critique. And I actually have a real life. I think that's really surprising to people. Like I have a life outside of life insurance. So in my real life, I have friends who listen to Dave Ramsey and read stuff on the internet, and then they'll kind of say to me, well, hey, I read this about whole life, or I heard Dave Ramsey say this, what do you think? And I hear it in similar kind of terms from other, financial advisors that don't use life insurance, which is a surprisingly large number of financial advisors. Maybe that's a whole other conversation about why there are all these financial advisors out there who are supposedly doing fiduciary, work for their clients and not talking about life insurance and annuities. Is just sort of a bizarre construct of why they would do that. But a lot of times they'll kind of level some similar critiques to what Dave Ramsey has said. And so when I thought about what Ramsey was saying, to your point, I mean, there are some points that he makes that are just like flat out not true. And I think one of them is, to your point, this whole buy term and invest the difference. Term is so much cheaper than whole life. And when I was at MetLife, I had this joke where I would say, like, look, when you go buy a mattress, you don't walk in the mattress store and say, give me your cheapest mattress. And like everyone says, I want to lay on it. I want to see if it's comfortable or not. There's way more going on than just out of the gate price, because you get, in a lot of ways, you get what you pay for. You don't just go to the discount rack at the mattress store.
Well, I did do that when I was in college, just to be fair.
You did that. You had no money.
Yeah, just to see what the baseline was. Yeah.
Yeah, exactly. So yeah. And then, but as you get older, you realize, hey, I'm going to sleep on this thing every night. Like, it's something worth paying for. And so I think for whole life, it's sort of this idea that, if you really wanted the cheapest thing, you actually wouldn't buy term insurance. And I think one of the great ironies of Dave Ramsey's argument is, well, term is cheap. Okay, well, what's the definition of term? Because there's 10-year term, 20-year term, 30-year term. There's term for life, which is what we would call a guaranteed universal life policy. And the price point for those products is very, very different. So if you just went for the cheapest one, you'd go for the 10-year product. And actually, you can even buy 5-year and 1-year term. And 1-year term is cheaper than 5-year or 10-year term. So really, if you extend that argument all the way down, you would just buy a 1-year term policy. And the problem with that 1-year term policy is that it only protects you for 1 year. And then you have to go back through, in most cases, back through underwriting to pay a new premium. And the new premium is higher than the old premium. And if you stretch that out, eventually you end up way overpaying for your insurance by going that route because you started cheap. And so I think just right out of the gate, it's a flawed concept to say buy term and invest the difference because term is cheap until you define what you mean by term. And as soon as you start extending the duration beyond 1 year to 5-year, 10-year, 20-year, 30-year term, you are necessarily paying more premium, but you're also getting a benefit, which is coverage for a longer period of time at a fixed rate. And so then if you kind of go one step further and say, okay, well, what about whole life? Well, now you're getting lifetime coverage at a higher rate, but you're also getting, because you're necessarily funding the contract for life, you have these cash values that have to appear in order to support the contract. I think that's another piece of the puzzle that Dave kind of gets all mixed up.
Can I stop you just for a second, Bobby? It's just, this is music to my ears. And again, that's partly why I wanted you to come on here, because it's like independent discovery. What you just went through was literally, I was in front of crowds, when I got into this lecture circuit, because it helped to have a PhD economist coming and saying, at first, I didn't understand this, but the more I learned about whole life, then, this totally makes sense. And so I would get up there just to your point, and I would put up a table showing the premium. It was like, I'd take a 30-year-old male in perfect health and say, you can go to the internet and go check this out. And, a 5, 10, 15, or 20, 30-year term policy, what's the level premium? And of course, it goes up. And I stop and I say to the audience, why? Is it just, I guess people get ripped off on 30-year term policy? And of course, they'll go, no, because you're more likely to die by the time you're 60. Right. And then I say, okay, so a whole life policy that completes by age 121, that's kind of like a 91-year term policy. So would you expect, and I sort of interpolate and I show the table, and I say, so how big, you think that number is going to be kind of a lot bigger than the other ones? And does that mean they're getting ripped off? And so they totally, okay. So anyway.
Oh yeah. And so I would even let's just take that argument to the extreme here and say, okay, so there's a thing in life insurance called standard non-forfeiture values. You have to have a certain amount of cash value in a permanent life insurance contract. So once you go to that age 121, you could theoretically buy it term for life. But as whole life's been around for 100 plus years, they wrote the regulations so that if you pay all that premium in, you should have the carrier's building up a reserve. You should be able to access that reserve if you surrender the policy early. Early whole life policies didn't let you do that. And so they would basically be pricing in that people would lapse to keep the premiums low. And so 1905, the Armstrong Commission comes along and says, no. If people leave, they need to have a cash value. Okay, well, that's where cash value comes from. It's a reserve, to your point, that naturally builds up to support this policy to age 121. And so I think people say, I'm paying extra for the cash value in whole life. No, you're not. Cash value is there specifically to support the death benefit for life. And if you didn't have it, you did have term to 121 with no cash value, then there'd be some sort of support of people who lapse for the people who stay. And you don't want that. You want equitable behavior where if you've overpaid early so that you can underpay late and you get out in the middle, you want your overpayments to be paid back to you, which is what the cash value is in the policy. And so that's the other kind of piece that I think Dave gets a little bit mixed up is he doesn't think about, to your point, the extension of mortality and the necessary increase in premium through that period of time, but also the fact that the cash value is there to support the death benefit. And so this leads to one of his most sort of obvious misstatements, which is when you die, you only get the death benefit, you don't get your cash value. And one of the things that I watched a bunch of interviews too with him, and what was so interesting to me is when he says that, what he says is you're paying for the death benefit, but you're for the full death benefit, but really most of that death benefit is your own cash value. But no, that is not the way it works. You only pay for the difference between the death benefit and the cash value. It's called the net amount at risk. All cost of insurance charges are denominated by net amount at risk. And so it's almost like Dave, and I think a lot of other kind of whole life critics don't understand the concept of net amount at risk and the fact that if you have cash value, you're not paying mortality charges on the cash value. Yes, your death benefit is still $1 million and maybe 60% of that is cash value, but you're only paying cost of insurance charges in the 40%. And so it's not a ripoff. And I think that's kind of the insinuation is that whole life's a ripoff because you have the cash value, but you pay for the death benefit anyway. No, you only pay for the net amount at risk. And that's why the premium is what it is. And so
can I stop you there, Bobby, again? Just let me say, like, typically how I try to a lay audience, let me say something, and then you can either tweak it and say, well, or, whatever. But yeah, because I think that's a critical point so there's a sense, so it's like UL, they kind of it's very transparent and, you can kind of see the moving parts on whereas whole life, it's more of a black box, but the advocates like me of whole life would say, yeah, but that's because the client just knows I just pay these premiums and you know what you're getting in terms of the guaranteed and then the dividend and the carrier takes the risk in terms of if projections are off. But either way, even for a whole life policy where it's not like broken out line item, under the hood, clearly the actuaries, when they're figured out, okay, a 30-year-old male in perfect health is applying for a whole life policy, what level premium do we need to charge? They're taking into account the fact that, well, gee, if this guy keeps making the premium payments and he's age 95, he's got a pretty high mortality rate at that point. And so, but if it's like $1 million face death benefit, and let's not worry about dividends at the moment, that if the cash value, if the carrier's collecting premiums for 65 years, the guy takes it out at age 30, and then by the time he's 95, he's got a very high mortality risk. But also the carrier looking forward knows at that point, we'll be sitting on 65 years worth of premiums that have been rolling over at interest. So even though the $1 million death benefit is a big looming liability, our assets, sort of earmarked to back up this policy will have grown, I'm making numbers up to 800,000. So really the pure death benefit coverage we're providing there is only the gap of 200,000. That's the net amount at risk. So anyway.
That's exactly right. And I'd say UL is transparent. Whole life is a black box, but if you reverse engineer a whole life policy, it works exactly the same way as a UL does. So just basic terms, right? Every permanent life insurance policy works the same way. You pay a premium, policy charges come out, whatever's left over earns interest. And there are basically two types of policy charges. You've got charges in whole life, charges related to premiums. So when you pay a premium, there's a load on the premium. You can think of it that way. And then you have a mortality charge. And so one of them is premium denominated. So as you pay a premium, a certain percentage is loaded out effectively. And so if you pay in a $10,000 premium, maybe 20% of that is an expense, 15% of that is an expense, 10%, whatever the number is. And then to your point, the mortality component, the cost of insurance charges are based only on the difference between the cash value and the death benefit. And where did the cash value come from? Well, it came from you paying premiums in excess of the load and the cost of insurance charges. So you're paying early more than you need so that you can pay less later on. And it's an exact formula. So not to nerd out, because if this is a lay audience, I don't want to get too technical, but there's a certain standardized prescribed mortality table that carriers use for the guarantee. So they use, it's called 2017 CSO. If you Google it and you really want to nerd out, you can go and find this table. And that table is exactly what they use to set the guarantees in any whole life and really any UL, almost every UL contract out there, they use some variant of 2017 CSO. And then they have a prescribed guaranteed interest rate assumption, anywhere between 2 and 3.75% the carrier can choose. And then the expenses are kind of the discretionary component. And if you put those three things together, you have a whole life contract. So it's not rocket science. The actuary doesn't say, for example, well, at 90, we think X, Y, and Z. They don't get to say that in whole life. They know the mortality table. They know the interest rate assumption. They need to lock in the expense assumption, and then it's kind of game over. And you have guaranteed cash values, guaranteed death benefit, guaranteed premium, because these are all guaranteed assumptions. And so I think that's the thing with whole life is it's actually a very simple, very logical concept. Again, you pay premium, charges come out, whatever's left over earns interest. You know the premium, you know the charges, you know the interest, therefore you know the cash value. And that cash value has to endow at 100 or 121. That's it. It's actually a really simple product, and I wish carriers would be more transparent because it's super logical how everything works behind the scenes. It's just that culturally, carriers typically have not had to show a lot of this stuff. But you could go, if you really wanted to, you could build an Excel spreadsheet and basically reverse engineer any whole life product out there and figure out exactly what they're doing. It's not rocket science.
And I have done that.
So Dave,
and gotten the CSO tables.
Yeah. But if Dave knew that, he would say, oh, I see that, the death benefit is level, but the cash value is increasing, but you're only paying COIs on the net amount at risk. But I don't, because it's a black box, I don't think people like Dave or lay people really understand that that's what's going on.
Let me say so you had mentioned in your personal life that some people come to you and they say, I listen to Dave Ramsey. He and I actually, when I lived in Nashville, went to the same church. Like one time I was sitting at an intersection to get out of the parking lot, and a guy waved me through, and I was like, oh my gosh, this is Dave Ramsey. So I knew he had been in my church because like he gave one of the, what the heck is that called? His program, the Get Out of Debt program. I forget what it's called, but he gave like the seminar for institution, like to the church, let him come in and do that. So I knew he was in my congregation. Hilarious. And then one time driving out, but having said that, I was upset with him because I don't think it's just pure ignorance that recently I reviewed a thing for this podcast. So the regular viewers know what I'm talking about, where he had a guy call into his show. I don't know if you saw this clip, Bobby, and a guy had a whole, took out a whole life policy, and he was going through it and trying to, meekly defend what he did. And Dave's just lecturing about what an idiot he was. And then at some point, it was like an 8-minute call. And near the end, the guy says, well, I mean, banks use this stuff. And Dave just goes, no, they absolutely do not. Banks do not use whole life insurance. If in fact, the regulator wouldn't let them. And so I went to the YouTube comments on that thing, and I said, well, it's funny because there's this thing called BOLI, bank-owned life, and I was giving links to the thing, and my comment kept getting zapped. So, I don't know. I guess I can't prove that it was a human and not a bot, but I believe there was someone maintaining his page to protect his viewers from knowing that, no, Dave is just confidently ridiculing someone with completely bogus. Anyway, so I'll stop there.
Yeah, I'm with you. And I think it's frustrating because what I always say is we have nothing to hide. I mean, and I think we get a rap in our industry as, these products need to be sold, they're not bought, and they're not transparent. Man, my view is the more you understand about this stuff, and my own personal journey, and I think your journey too, just from hearing it a little bit today and other times, like the more you understand, the more you'll like this product. And so we as an industry should show more because it really makes sense. And there are rules and regulations to make this customer friendly. When it's sold appropriately, it's an incredibly powerful product. It's just really misunderstood. And it's a shame that guys like Dave Ramsey, I don't want to pick on just Dave because there's a lot of people like that, will sort of not take the time to really understand it before they level a critique at it. And that to me is part of the problem.
Yeah, we don't want to be sexist. It's Susie Orman too. She also does not know what she's talking about. And again, with this, folks, somebody can level false critiques of something and maybe the thing still isn't great. So we haven't here proven. So to that point, Bobby, do you want to then, what was interesting in your article is you said you found the Holy Grail. You actually had a very old policy. So maybe, can you first explain why is it tricky to go look, like if you want to say, how did this bond fund perform? That's pretty easy. Or how did the S&P 500 perform over the last 30 years?
Yeah.
But if you want, and I've encountered this myself, to go do research to say, what's been the average rate of return on whole life policies over the last 30 years, you can't just go Google that.
No, you can't. You can't. It's actually kind of weird that you can't Google that, but it makes sense the more you understand. So, there's a difference between gross returns and net returns. you can kind of figure out the gross return by looking at historical dividend interest rates. So again, just basic term of that. We've been talking so far about what I would call non-par whole life, where we have a guaranteed interest rate assumption, guaranteed mortality assumption, guaranteed expense assumption that creates a guaranteed premium, guaranteed cash value to support a guaranteed death benefit. So there's no moving parts. In the real world, of course, and especially when you think about an infinite banking concept, we're not talking about non-par whole life. We're talking about participating whole life. And so the kind of corollary to non-par in the par world is a product where everything is still guaranteed in the base contract, but obviously the expenses are higher than the carrier actually incurs. The interest is lower than the carrier actually earns, and the mortality is more punitive than what the carrier's actual experience is, because the carrier's underwriting these policies. They're underwriting you at preferred or preferred best. The 2017 CSO assumes no underwriting for the mortality table. And so the premiums in the whole life policy are higher than if you just based everything off of kind of current assumptions about expenses, mortality, and interest. And so to your point, in a UL contract, the carrier just sets non-guaranteed rates, but they have the right to change the rates later. Well, in a whole life contract, all the premiums are based and the cash values are based off of the guarantees. But if interest is higher than the guarantees, or expenses are better than the guarantees, or mortality is better than the guarantees, well, there's profit. And I think one of the most powerful concepts in whole life is just that there's, if whole life is expensive, then that must mean that it's profitable. I heard this line from a Northwestern rep this week that I thought was just so good. If whole life is expensive, then that must mean it's profitable. Most people go, yeah, I guess that's true. And then the follow-up question is, okay, well, who gets the profit? Well, the people who own the insurance company. Okay, well, who owns the insurance company? Well, if it's a mutual insurance company, which is basically only mutual companies sell whole life. So if it's a mutual insurance company, then who gets the profit from these expensive premiums? The people who own the insurance company. Who's that? The policyholders. Oh, well, how do the policyholders get their share of the profits? Well, that's called a dividend. And so you get this dividend that can be paid to you in cash, but most people put it back in their contract to buy additional insurance and grow cash value in their policy. And so that the interest component of that dividend is called the dividend interest rate. And carriers have histories of their dividend interest rates, in some cases going back more than 100 years. And so when you go back to this concept of a gross rate and a net rate, you can go back and see the gross rate. And assuming that mortality isn't at the guarantees, and assuming that expenses are under wraps, that gross rate is actually a pretty good sort of proxy for, okay, assuming expenses are reasonable and mortality is reasonable as any other insurance contract, what's the sort of rate of return you're earning on a gross basis? You can look at the DIR. And I think that's a better proof point than most people give it credit for. Like, we've got 100-year history of what the actual interest component has been on whole life contracts. It follows certain patterns. There's explanations for why they do what they do. Historically, they've been really strong. Like, this thing works at the gross rate. And again, I think that kind of goes underappreciated. Now, the hard part is, to your point, why you can't Google, okay, what's a normal policy performance for a whole life contract, is because the gross rate is up here, but the net rate is policyholder specific. So a 35-year-old's net cash value IRR is going to look very different than a 75-year-old's net cash value IRR when they buy the new contract, because obviously the 75-year-old's older, the mortality charges are higher, the premiums are higher, the expenses also may be higher because of more underwriting, more commissions, whatever. And so the returns on the cash value are going to look totally different for those two policyholders. What if the 35-year-old buys a pay to 100 contract, which is more protection oriented, so less cash value, more death benefit, or buys a 10 pay, right, more cash value, less death benefit for dollar of premium? Okay, well, the IRRs on cash value look very, very different. And so that's where, when you talk about sort of Googling average whole life performance, the problem is that every policyholder effectively has a unique policy performance in terms of the net rate, even if everybody has the same gross rate, because every policyholder is a different age, rate, premium size, policy selection. It's way too granular. And so I think in terms of comparisons, the gross rate is the right point of comparison. But the net rate is what clients actually experience.
Let me stop just to make, I'm tracking with it, but just in case people are quite familiar with the terminology here, because this is critical. I'm glad you naturally went into this, because I was going to bring this up to make sure you covered this distinction. So, right, if people are trying to look at and say, oh, well, what's the average rate of return on T-bills or 10-year treasuries, blah, 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 S&P 500, real estate, and then, so what about life insurance as an asset class? Yeah, they can, as you say, easily go look up and see what has been the average dividend rate on, whole life insurance, or, they can get more specific about what class of companies they're looking at or what have you. And then they can look at what's the rating of these companies in terms of their risk of default and that kind of stuff. But the more they poke, that dividend rate looks pretty good. But then the critic or the cynic will tell them, whoa. Just because Northwestern or Mass Mutual says their dividend rate over this period was on average X, that doesn't mean if you get out a whole life policy with them and you're paying premiums, and then it's some give like 11 years into it, you ask, okay, given the out-of-pocket cash influx that the client had to pay, and now looking at the cash surrender value as of year 11, what is the average annualized internal rate of growth on that? That's not the same thing as what was the dividend rate on average over that period. So that's the distinction we're drawing. And
correct.
So, okay. So can you maybe, can you maybe just once again explain why it's not like they're lying to you, but why it totally makes sense that you can't just go from the dividend rate to what the internal rate of return on the cash value is?
Let me give you just a simple analogy everybody's familiar with. So if I look at mutual fund performance without taking fees into account, and I just look at the top line performance and I don't look at fees, that's a real number, right? That is a real performance of the asset. That is the gross performance of the asset. That is a comparable number across fees. But once you take fees into account, then you end up with a different performance for funds. So there may be funds that perform really well but have really high fees. Or let me give you even a better example. Funds have different tax drag. So if a fund has a lot of turnover or a lot of distributions and you're in a high tax bracket, that fund is going to deliver you a net after-tax return that is much lower than what the headline return is, even after you take the fees into account. So when you think about any investment you make, and then by the way, if you have an advisor and the advisor is wrapping the assets and charging you a planning fee, well, you have to take those line items kind of into account when you think about your actual net return that you receive. So there's a top line fund performance return, and then you've got fees, and then you've got tax drag, and then you got advisory. So everyone's very clear with that on the investment side. Very similar thing going on here in life insurance, where there's a gross rate up top. That's the dividend interest rate. And then you have a mortality deduction, which, just pause there on this because this is really, really important too. Mortality is not a cost. This is something people get really confused about because they say, well, what's the IRR on my cash value? Well, part of the reason why your IRR, if your dividend interest rate is 5 and your cash value IRR is 3.5, probably 75 basis points of that 150 basis point difference is due to mortality protection. That is a benefit. The death benefit is a benefit. The cost of insurance is the way you pay for the benefit. So on an actuarial basis, that's net neutral, right? You're paying for a future benefit, and you don't know if you're the first person to die or the last person to die. And so that's the fair market value of the death benefit protection you get. That's not a cost. That is a pre-funding of a future benefit that you will receive if you keep this policy for long enough. So, but it is a cost in terms of the IRR. We calculate the IRR. It's a benefit, it's pre-funding a benefit, but it does drag down the IRR. And then you obviously have policy expenses, which are commissions, carrier overhead, state premium taxes, whatever else gets baked in there. And so when you kind of roll that down, that's why there's a difference between the top line rate, the DIR, and what you actually get in terms of cash value IRR. And to my point earlier, because the mortality charges are different by age, a 35-year-old's policy is going to look very different than a 75-year-old's policy. There can also be difference in overhead allocations, the carrier makes, commissions, whatever else, payment patterns that are going to create different IRRs. It's not really that dissimilar from what we see in the investment world. After you take into account fees, taxes, and advisor fees, we have the same sort of dynamic going on in life insurance, just we don't have any taxes. Instead of taxes, we have mortality costs. And the mortality costs fuel a future tax-free benefit. So that's where I think people get really caught up because they say, I want to Google the performance. Well, okay, what we need to find is the perfect policyholder that's held a policy for 25 or 30 years and basically validate that the policy did what it was supposed to do to essentially prove that the expenses were what they were supposed to be, the mortality was what it's supposed to be, which means really the thing that matters is that top line gross dividend interest rate. And you can kind of base your decision off of that. And that's, again, to your point in the article, that's what I found. And that was why that article cleaned up very nicely.
Yeah.
Because one of the other things that Dave Ramsey said, and this is really what leads into this, is what Dave says, and this blew me away. This is yet another one of these things that just is like, not factual. And even if it was factual, you can't get the data. He says, on average, whole life policies perform at 2%. I think was the number he threw out, 1.5 or 2%.
Yeah, I think I've seen him say 1.5. Yeah.
Yeah. I think I know what he's talking about. What he's talking about is non-participating whole life. Well, you and I are not talking about non-participating whole life. We're talking about participating whole life. So I think Dave's got his stats a little bit messed up, but let's give him some benefit of the doubt there. But another way to interpret it is he has no idea what he's talking about. And so how do you kind of prove when you can't Google it that these things do what they're supposed to do? That, for example, the carrier isn't sucking up that big gross rate and really high policy charges, and carrier clients are actually getting good rates of return on cash value, even after taking expenses and mortality into account. That's what you got to prove. And so his point is, a carrier gives you the big top line rate, and then they just destroy it with expenses. Well, yeah, let's look at a real policy and see if that's actually the case. Because on the illustrations today, that's not what happens. So is it a bait and switch where the carrier is doing that and then increasing everything after the fact? You got to find an old policy that's in perfect shape to prove that it's not. And again, that's what I found from the article.
Yeah, before we get into that specific thing, which will be the last half of this discussion, but yeah, just to make sure people are getting the distinction, that the point you made, that how, like your example, I realize I'm backtracking here. I'm trying to make my point for the listener. When you talk about different funds and they could have different fees, I could see people thinking, oh yeah, so those fees to me mean nothing. It's just that they're overhead. And if one fund, is more lean and mean, and the other one, they've got, their executives live in posh or work in posh offices on Wall Street or wherever, that I don't care about that. That doesn't help me as my bond fund. But to the extent that when we say there's the dividend interest rate, and then that's higher than what the take home, internal rate of return, the cash value is, that one of those components of that gap is the mortality expense. And you were saying, well, that's not just nothing, like you're pre-funding something. And so the way that comes up is, in my circles, is people will sometimes just casually say, oh yeah, infinite banking makes sense if you're healthy, but if you're not in great health, then the pure cost of insurance doesn't make. And so I can just go through and show them using, just like you say, the 2017 mortality tables, and say, let's assume unrealistically there's no overhead and they're charging you just a pure actuarially fair premium. And I'll just work backwards and just, and I'll have some guy that's got a 10% chance of dying every year, and one guy's got a 1%, and I'll, making up numbers. And I'll just show that the internal rate on the cash value for the sicker guy is lower. And so I'm saying, see, but of course he's much more likely to die and get the death benefit. And so
exactly,
if you do it all, it's like in expectation, it's the same rate of return, all things considered, identically, because that's by construction, how I did the example to rule away all transaction costs and stuff and the slippage. So that doesn't mean in the real world, every carrier is perfectly efficient, obviously, but I'm just showing them that no, your intuition is wrong, that a 90-year-old who takes out a policy, if you take into account the death benefit and the expected return from that, it's a wash, at least, at a first pass. So anyway,
No, I completely agree. And what I'd say to that too is no illustration shows when you're going to die. No illustration says you're buying this at 72 and we're going to show you a death benefit payout at 85 because you're going to die on May 5th, 2035. Like that, no illustration shows that. And so every illustration has to show mortality going all the way out. But to your point, on an actuarial basis, you are going to die earlier if you're 70 versus 35. And you're going to pay higher COIs because of that. And that's okay because the benefit fits the COIs. And so I think that's the dynamic that's so powerful.
Okay, so do you
want
to
talk about the policy?
Yeah. You wanted to explain how you got your hands on this thing and then what you found?
Yeah, sure. So like I said, I completely agree with your point about mortality and that not being a cost. I will add one other piece of the puzzle though on the expense side for the funds, which is, expenses do matter in whole life. They really do. In the same way that if you're assuming that a fund company is charging more for their fund and that's giving them more profits, you should care about the expense ratio at the insurance companies that you work with for mutual whole life. The lower expenses they have mean more benefits to policyholders. And there are some companies that manage expenses better than others. And so I think that's still an important kind of element of the story that you should not ignore, that is comparable to the investment world. So what I found was this perfect policy. So this is someone in my family. And I knew this person had an old whole life policy, and he called me up one day and said, "Hey, swing by my house. I've got something you want to see." And what he showed me was the original proposal from 1987, I think, that showed his original, like what the agent literally showed him in 1987. And then he sent me all of his current statements. And so I had a point of comparison. I had what the original cash value was supposed to be, and I had what his actual cash value is right now. And I had a line by line, accounting of what the policy looked like from 1987 until now based on the original illustration. So the proof point is, okay, this person bought this policy in 1987. So they own, or 88, I think actually. They bought it in 88. They have kept it, have made every premium payment, have never taken policy loans out of it. And so it's like, from a comparison standpoint, perfect comparison because there's no noise in the contract, right? What happened on the illustration is what actually happened in the real world in terms of him paying premiums and not touching the cash value. So I'm not saying you shouldn't take policy loans, right? But he hasn't. And It's just like pristine from a comparison standpoint. So I went in there and said, okay, well, I can see he's paid, $2,200 in premium or whatever. And I can see the cash values every year. I can actually recreate what this illustration, what the expenses were. I know how this thing works, and I can go through and say, okay, I can see exactly how this policy cash value shows up every year. What then, okay, well, the illustration is not accurate. We know that. The illustration was run at 10.25%. The DIR has not stayed at 10.25%, obviously. And so the original projection showed like $500-something thousand of cash value. That isn't the right benchmark. And I think this is one knock on permanent life insurance and whole life in particular. They'll say, well, yeah, but look at the 1980s, dividend interest rates were illustrated at 10%. Nobody got 10%. This must be a bad product. Well, yeah, because interest rates back then were 14 or 15%, and now they've come down. If everything was working properly, you would expect dividend interest rates to come down too. And so that's what you would expect. So the real question is not, should the policy have $500,000 cash value? No, it should not. The real question is, given the expenses, which again, you can see by just reversing that formula we talked about earlier, right? Premium in, expenses out, add interest, you get cash value. Well, I can go back and figure out then what the expenses are if I know the cash value and I know the interest rate. So that's easy. So pull the expenses out. So if I go back and take the actual dividend interest rate, plug it into the cash values every year. So as the DIR went down over time, as it should, as interest rates fell, we should expect to see the policy perform on the Excel spreadsheet very similar to what it has done in real life, if expenses haven't gotten worse or if mortality hasn't gotten worse. So that's what I did. I plugged in the real dividend interest rates from 1988 until now. Final cash value was off by like $400 out of $250-something thousand or whatever the numbers were. And so to me, that, and by the way, it's better than what I calculated because they've had some expense reductions and some mortality improvements since then. So actually, this is a more efficient contract than when my family member bought it in 1988. So the title of the article is Proof Pudding, because the proof is in the pudding. We've got a policy from 1988. It's done exactly what it's supposed to do. It delivered exactly the IRR it was supposed to deliver. The carrier did exactly what they were supposed to do. The policy performed exactly as expected. And yeah, did it perform at 10.25%? No, because interest rates went down. But if you compare it back over time to T-bills, to even buying corporate bonds, to even buying low-rated corporate bonds, even without taking taxes out, this thing performs better than all those asset classes. And so to me, it was a stunning sort of proof that whole life in this context did exactly what it was supposed to do by maintaining the expenses and keeping them low, by maintaining the mortality and keeping it fair, and then by crediting that gross rate and delivering a net return that was exactly the same. The spread, the difference between gross and net was exactly the same as what it was originally illustrated, which is exactly what you want. And so to me, it was like proof that, hey, whole life does what it's supposed to do. And if you actually run the returns on an IRR basis, it was better than treasuries by a good margin. It was better than high-rated corporate bonds. You kind of had to dip into pretty deep, low-rated corporate bonds to get something comparable to whole life, which is exactly what you would expect. Because what's the carrier investing in? A diversified bond portfolio. And they're giving you the benefit of it. And so it just did exactly what it was supposed to do.
Okay, great. So let me paraphrase and then have you comment. So the original illustration that your family member saw back in either 87 or 88 when they pulled the trigger, if that looking ahead to say what would be the cash value of this policy in the year 2023, it actually, in reality, was not as high as what that thing said back in 1908. But the reason is not because the carrier in those projections or the illustration was optimistic about what the expenses would be. It's just they assumed interest rates would be how they had been in the 1980s up to that point, and then projected that forward.
Right.
And so the big reason for the divergence was that interest rates came down. And people go, in case people don't remember that as an economist, I know this, but if you chart U.S. interest rates, I mean, they've just been on a secular decline from the early 80s, just, all the way down to zero, if we're talking short-term rates. And so so your point is, it would be unfair to penalize them, the fact, for them to, and then those weren't guaranteed, by the way. Those are, of course, when we say, what did they say was going to be worth in 2023, that would have been on the non-guaranteed side. So maybe that's an important point to make. So they hit the guaranteed side.
Oh, yeah. It is a super important point to make, because if this had been a universal life policy and my family member had illustrated it at 10.25 and set a very low premium, assuming that rates would always be at 10.25, which is what a lot of people did, then this policy would have lapsed years ago. Mm-hmm. So because whole life is based on the guarantees and the guaranteed premium hasn't changed and the guaranteed cash values have actually done better, which I'll explain in a second, then we have a situation where the policy stayed in force. It's just a question of, okay, what's the cash value growth? And to your point, you can't penalize the policy because it didn't grow to what the original illustration was, because interest rates have been coming down. What you want to know is, as the gross DIR goes down, did the policy move in lockstep with the gross DIR the way it was supposed to? And the answer is yes. And I think that's the power of it. The reason why the guarantees look better is, I think, also a really important point. If you take your dividends and you put them in your policy as paid-up additions, those paid-up additions have their own guaranteed cash value. So as you get dividends, you lock it in. And so the guarantees are actually better because he's had dividends, and those dividends have bought additional guaranteed death benefit and additional guaranteed cash value. And so actually the policy's done really well by any metric, any measure you look at it, it's done phenomenally well. Maybe just in simple terms, this is the pay to 100 policy. The difference between the gross rate and the net rate for this policyholder was 1.7%. So if your gross rate was 6, you would expect your net rate to be 4.3%. And that was on the original illustration. And that is the same now. And actually, here's what's crazy. If you take the same policyholder, 35-year-old male super preferred, and you run them on a current whole life contract, the current illustrated expense ratio for this policyholder is about 1.7%. So it's just been remarkably consistent. And so, yeah, to your point, it's a good one, right? The gross rate will move. You just want to make sure the net rate is moving along with it. And that's exactly what we saw happen.
And you even have, so again, folks, I'll put a link in the show notes page for this episode to the article. You want to see it for yourself. But you even got, Bobby, here a chart showing the Moody's AAA composite yield against Northwestern's dividend interest rate. And the gap is, so in 1988, 89, they're actually fairly close. So the Moody's AAA is a lower yield than the dividend rate on the insurance company. But then even over time, the Moody's AAA yield drops more than in other words, the gap grows. So the dividend rate for the carrier didn't fall as much as just the general composite AAA bond yields did.
Yeah, and a lot of that's just because from a carrier standpoint, it's one big portfolio.
Right.
So you have old money, you have new money, you're averaging them together in a falling rate environment. That portfolio stays higher than new money rates, like today in a rising rate environment. That isn't necessarily the case. So new money rates have popped up, interest rates have popped up, dividend interest rates are moving up, but slowly. And so you get so in a rising rate environment, that relationship inverts.
Okay. On
average, that gross rate should look like corporate bonds plus a spread, because the carrier does more than just invest in corporate bonds. And that's exactly what we see, is we see an advantage to that.
Okay. So again, just to paraphrase, you're saying the reason, when we look at, if we're charting over time, the carriers announce dividend rates versus what the spot yield is on a mixed portfolio of bonds, the bond, like the market rate of the bonds keeps changing quickly, whereas the carrier, it's got like a turnover, right? It's got a whole portfolio of bonds, and then as current rates move one way or the other, yes, the new stuff coming in, but there's like a bathtub full of bonds that are maturing, and so there's like a memory in the carriers where it's like a look back period. So on average is going to be the same, but yes, there's a turnover.
Yeah.
So in a falling rate environment, the carrier does better. Now, if interest rates go up over the next 20 years, there's going to be a bit of a catch-up lag.
Right. That's right. Yeah, exactly right. You can even if you just take an average of the Moody's AAA and you do like 7-year rolling average, it's pretty close to the DIR.
Okay. So I guess last question here. We just got you for a few more minutes, Bobby. So I think we've done a good job here of explaining to the viewers like the theoretical, conceptual points. Now they have a much better understanding, but still, what do they do? Okay, but if I'm looking at different, an agent comes and presents to me an illustration, how do I still, tease out these different elements? Like how, what do I know about like the carrier? Like how realistic are their projections? You know what I mean? So you've established if they're building into the illustration the idea that, interest rates we think over the next 30 years are going to look like such and such, like, it can just give a little bit more of like how can the client or potential client isolate that assumption from everything else just to kind of get a benchmark.
Yeah. So I'd say there's a couple of good data points. One is the DIR as a headline rate is helpful. It's not the whole story, but it's a helpful understanding to as a baseline of like, look, Mass Mutual's got a 6% rate for DIR. They're really going to credit 6%. Now, Mass Mutual, for example, takes some expenses off of that, and that changes by product, and there's a way to calculate what that is. But let's just say it's 5.5%. That's really what your cash value is going to earn in this contract. Now, what the illustration is for is not a demonstration of what the earnings are supposed to be for the next 50 years. That's what the earnings currently are projected out for 50 years. And so I think one of the things people get really confused about with illustrations is they think illustrations are projections. No. Illustrations are demonstrations of how the policy works. So data point number one is, okay, what's the gross rate? Let's just say it's 6%. Data point number two is, all right, what's the next rate? And again, as we've already talked about, that's going to be different for every policyholder over different time horizons, depending on the policies they choose, how old they are, all that kind of stuff. So look at the net rate in the contract. Let's say the net rate, just in this example, is 4%. So you have 6%, or let's say 4.5%, 6% down to 4.5%. Okay, well, that tells you that the expenses are 150 basis points. Now, some of those expenses may come right off the DIR. Some of them might be baked into the premium, and some of them are mortality charges. But your total net cost kind of expense structure in the contract is worth about 150 basis points over the next 20 or 30 years. As the DIR changes, because it's going to change every year, what you want is that 150 basis points to stay the same. So if the DIR goes up, you want the policy performance to go up lockstep. What you don't want is a situation where the DIR goes up and your policy performance lags. What that would mean is the carrier is charging you on mortality than they originally thought, and they're charging you more in expenses, which means really they're not managing their business very well. And by the way, it doesn't really happen very often. If you look at carriers' announcements every year, they really don't change their expenses or mortality very often. And so really, those are the two really key data points. What's the DIR? What's your net rate, right? And that's the number right there. And then the other data point I think that's really important is what's your death benefit? Like you some portion of that difference between gross and net is due to cost of insurance. And if you have a bunch of death benefit, that's a real benefit. Now, a layperson can't calculate the actuarial value of that death benefit. So this is a little bit of like, see how the wind is moving here. Mm-hmm. But if you've got a policy with a lot of death benefit, and let's just say instead of 150 basis point difference, it's a 200 basis point difference, that's not because your agent's making more commission. It's not because the carrier is putting more overhead on your contract. That's because you have a bunch of death benefit. Your net amount of risk is really wide, and you got to pay for that. Mm-hmm. Now, it's fair value, because if you die, you're going to get a lot more of a benefit from that, but you got to realize that that's in there. So I'd say if you put those three things together and say, all right, is this whole life policy going to do what I want it to do? Look at the DIR, look at the DIR history for the company, understand how the carrier is investing, understand how they're generating returns. That's part one. Part two, look at your difference between gross and net. That's going to tell you your total expense structure. And if you want to kind of tease out the mortality component, if you've got a lot of death benefit, you should expect that total expense structure to be higher because you got more death benefit there, and that's a benefit to you. If you do an overfunded contract and that corridor is lower and therefore the expenses are lower, well, that just means you have less, you're pre-funding less of a future benefit in terms of your death benefit. Don't overcomplicate it. Mm-hmm. I think one of the things too is like, people get really worked up into comparing illustrations. That is not a good idea. You want to compare the gross versus net, the expense load. That's a helpful data point. And you want to compare the gross rate, DIR, and understand how the carrier does it. I can tell you right now, there are illustrations being shown today for policies that look better than other illustrations, you roll the clock forward 30 years, that relationship could completely invert based on how the carrier actually invests and actually performs. Illustrations are just a snapshot. It's like, imagine you're a movie reviewer and you go to the theater and you walk and you sit in the seat for 2 seconds, see 2 frames, and then walk out and write a review of the movie. You didn't see the movie. Well, if you look at an illustration and decide what you want to do based on just the illustrated performance on today's current DIR, you're watching 1 frame of the movie. You're going to own this thing for 50 years. You better understand the company you're buying it from. And so I would argue, like, from that standpoint, understand when you're buying whole life, you are buying a product and you understand the expense loaded in the product and the expense structure in the product. That's important. But you're also buying a company. So you really got to understand the company, because ultimately you own a piece of that company and you will get and you deserve your piece of the profits of that company. So you better understand what you're getting. And I think that's kind of the difference there in practical terms for picking whole life. Again, don't overcomplicate it. Don't run off the illustration. Understand this as a financial contract and look at it that way. The illustrations are just there as a demonstration. They're not a projection.
Okay, well, thanks. That's a great place to end this discussion. So, folks, my guest has been Bobby Samuelson. I encourage you, if you like to nerd out on this stuff, check out his Life Product Review. It is subscription-based, but we'll put the free article that he gave in the show notes of this page, or this episode, I should say, and also of Life Innovators. So thanks, Bobby, for your time.
Thanks. Appreciate it.
Thanks, everybody, for tuning in. We'll see you next time.
This concludes another episode of InFi, The Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.